Hey guys, what we really are super excited about tonight's webinar. It's a good topic. I mean, there's nothing as far as what I've learned over the years being in this business, financial, investing, real estate, whatever. There's a lot of ways to create wealth and stuff, but it's like I always go back to what Dr. William Danko in The Millionaire Next Door said. He said that one thing separates those who are wealthy millionaires from those who are not. And one of the biggest factors was those who were wealthy spent an inordinate amount of time learning how to reduce taxes. And that was one of the biggest differentiators. That was it. That's because imagine, and you guys talk about this, Jake and Chris, I love this about taxes, is it does set you apart because at the end of the day, you're saving so much money, way more money at the end of the day to put back into your investments, your business.
Well, it's like you're saying, it's not just the money you save, it's the ability for that money to then compound year over year over year. And the exponential effect that it has pays off so much in the long run. And that's one thing that people miss is it's not just the dollars saved this year. It's what I do with those dollars and the power of those dollars year over year.
The eighth wonder of the world, compounding interest, right?
Absolutely.
I love it. I really do. Like that's my jam. I love it because you think about all of our real estate guys that we know very, very well. A lot of you guys are real estate investors. And if you don't know about cost seg or any of that stuff, or, basically it comes down to, buying real estate 30% below, basically over time is 30% savings on real estate. I mean, if you don't know that strategy, gosh, you're paying so much more. You're so much further ahead of the game just because you know a tax strategy.
And that's one strategy.
Yeah.
Right? That's one.
Yeah, exactly. So taxes is one of my favorite topics because it's where the rubber hits the road. And unfortunately, a lot of people don't take it seriously enough because it's not, fun, but money is fun, guys, because you can put it to work.
Well,
all right.
One thing we're going to talk about tonight, Kendall, is kind of our role as entrepreneurs and investors, because taxes really is something we can impact. But so often I think it's one of those things that people just think, hey, it is what it is and there's nothing I can do. And the first thing we have to do is take control, because there really is a tremendous ability to impact that tax bill, but you got to do something about it.
Yeah, and that consistently doing it and it's worth it. I've learned this over and over too with pros who know what they're doing, like Chris and Jake, for example, in Tax Hive. If you have the right people in the seats, like I've heard a lot of people who are very frugal and won't pay for extra support or services on things. I can't tell you how much that has saved me over the years as using the pros. Will save me far more than I ever would save. You know what I mean? As far as not paying, right? Anyway.
I always ask people, how much did it cost you to get your taxes done? and the answer isn't whatever I paid or didn't pay. The answer is what was my overage that I paid that I shouldn't have. That's the true cost.
For sure. Oh, I love it. You got to speak in my language. So this is good. Let's get started tonight, guys. I'm going to do a quick intro of Jake and Chris here. So let's make sure everything is recording and we're good. Everybody, thank you so much for being on. We really are excited to have Chris and Jake here. So again, don't wait to reduce your taxes is the title of our webinar tonight. And that's for a very good reason. It's not April, it's not October, it's not March, guys. So why are we talking about taxes? Because you should be thinking about it right now. You absolutely should. If you're not thinking about it now, you're already losing the tax game. So it's really true. We have a lot of webinars we do. This are a few lists of our webinars we've done this year and a few more coming up. Stay tuned. If you are on this webinar, we'll make sure and send you details for our upcoming webinars. One of the best things about this is we have a lot of different topics, experts, advisors, attorneys on asset protection, tax strategies, estate planning, wealth creation, real estate, investing, just ways you can be better financially prepared. And we love what we do. Join our webinars. Everybody, if you haven't seen, we do a YouTube channel where we post a lot of the content from these webinars. And we strongly suggest you jump in and subscribe there. We have so much content everywhere. You can go to protectwealth.com and jump onto our content, or go to YouTube and go to Protect Wealth Academy and then subscribe. Always suggest, if you do subscribe, make sure you do hit notifications on there, because then you'll see this stuff pop up as soon as we post it. And we post a lot of content. So make sure and do that. YouTube.com, search for Protect Wealth Academy. There you go. Subscribe. All right. And a few events coming up next week. June 13th, 14th, and 15th, our 3-day Asset Protection and Wealth Creation Summit. I'm not going to lie, guys, this is probably one of the best events you'll ever see. I know I'm biased, but it's true. There's some good people on here. They really, really are truly incredible presenters and masters in their fields, attorneys and advisors on every topic, how to get yourself in financial shape. August 1st, 2nd, and 3rd, a live stream. I believe we'll be doing some things with Tax Live on that. And then we do have a live event, guys. So if you want to get off Zoom for a while, I know some of you have Zoom fatigue and you want to go out and see some people's faces in real life. If that's you, October 10th, 11th, and 12th in Phoenix at the Hilton Airport Hotel. Great place. We're excited, but it only fits 150 people. That's the maximum to let us put in that room. So if you want to register, I would do it soon at protectwealth.com. We're super excited about that event. And as you can see, this is a picture of our agenda. And it's not a light workshop, with a lot of fluff. Absolutely not. This is absolutely packed full of how to set up your LLC, your corporation, your living trust. Does it work for your business? Does it not? How to reduce and eliminate, capital gains, estate taxes, probate, things like that. There's some strategies and tools that your average, advisor, attorney, brother-in-law probably can't do some of this stuff. You want a good advice from people who know how to do asset protection, taxes, estate planning, and tie them all together. Sometimes what's good for taxes isn't good for asset protection. What's good for asset protection isn't good for taxes. That's why we like Chris and Jake, because they know that stuff. They actually do. They know this stuff. So before we start, guys, we are an asset protection company, so we always do a disclaimer. I'm sure you guys have yours, but remember, we're not giving specific legal advice. If you need specific advice, seek out a competent professional advisor for you. Guys, thanks so much, Chris and Jake, for being on. I'll let you guys kind of do a little intro about yourself, if you would, kind of what got you into taxes, because most people always ask that question, what got you into taxes? So I'll let you guys take it away from there. Some great content tonight, guys. Sit back and take some good notes.
Hey, thanks so much, Kendall. We are just appreciative of the opportunity to be here. And we'll jump in. We know everybody's got a lot of more exciting things than to talk about taxes, but I promise it's going to be worth your time. The short time we have with you tonight, we're going to make it worth your while. I'll answer your question first, and I'll let Jake answer his. I've been involved in a number of different businesses for years, and I've always kind of serviced the small business owner. And kind of as an ancillary benefit, we offered a partnership with some tax services to clients for years and years and years. And I'd had a previous relationship with Kevin O'Leary. Kevin was a previous partner in a business. And in a conversation I had with him down in Arizona, we talked about the tax game and the impact that it had on small businesses and business owners. And as you can imagine, Kevin just loves the small business world. That's what he does. And I didn't realize it, but Kevin had actually been a part of a firm like Tax Hive previously. And he got excited about it, about the impact that we could have and what we could do. And kind of one thing led to another, because we'd been the small business owner that had overpaid, and perhaps let me share a story tonight where I blew a gasket because I realized what a terrible job my accountant was doing and how much money I was overpaying. And this conversation with Kevin just kind of led down this road of, hey, there's a lot of good that we can do and have a real impact on what we believe is the lifeblood of America, the entrepreneur, the small business owner. And one thing led to another, and here we are. And Jake's probably got a more exciting story than mine, but that's what led me down this path, was just genuinely serving small business owners, that partnership with Kevin O'Leary, my own experience of absolutely paying far more money than I should have been paying, And that all kind of culminated in us founding Tax Hive.
That's cool.
Yeah, and I'll jump in there too. So for me, I actually kind of got into this business on accident. Actually, it was about a decade ago now, and I was an employee. I was a W-2 worker. I always worked my job, and then I always had gigs on the side. I always sold different things and just did things to kind of keep myself busy. And so one year, one of those side gigs that I had, side hustles, whatever you want to call it, led me to a woman, and she did my taxes. She showed me how, the small fortune I was sinking into this side business could actually be a deduction. And so that year I got the biggest tax refund I had ever gotten. I literally, when she texted me the number of how much it was going to be, I dropped my phone on the ground. Literally, I was like, it's incredible. And so I literally just kind of stalked her from there and asked her questions and, where do you work? How does this, teach me more about this? And, from there, I learned from that company, ended up a few years later starting my own company, and over the course of about 6-7 years, we brought on somewhere like 2,000 clients all around the country. And, about this time last year, I ran into Chris and learned what they were doing over there at Tax Hive. And they were bringing on 2,000 clients in about 6 months when I thought we were doing a good job doing it in 7 years. And so the rest is kind of history there. But, just to echo what you said or echo what Chris said, the love of small business and kind of that shock factor of, wow, there are legal and moral ways to pay extremely less taxes than I have been in the past, and just kind of a fascination with it since then. So
cool. So cool. You guys are speaking my language. I love it. It's they're actually both really cool stories. See, you guys learned how much you can save. And that's what we find with our students all the time, is they can save a lot of money.
And absolutely.
You don't know what you don't know. That's the worst thing about taxes. You don't know what you don't know. So there's so many strategies. You got to figure it out. Okay. So you guys have a presentation PowerPoint. I'm not sure if that's you or Chris running it.
I think that was Chris. So he might have dropped. He might have dropped off there for a second. I'm not sure if he's having tech issues or,
well, I do have it here.
Oh yeah. There you go. Perfect.
I mean, whatever you want to do there. I don't know.
Yeah, that'll work. So what we talk about, and Chris is chiming right back in here, is the right approach. What is the right approach to save money on taxes? And so, our firm, we specialize in working with small business owners. Kevin O'Leary, he's an investor in our company. He's one of our partners. His DNA runs through our business. And so we just, we believe in small business, and we want to see them keep every penny they're legally entitled to. And what a lot of people ask is, what's the right approach? And so welcome back, Chris. We're going to hand over that present to you there.
I got booted for just a second, but can you hear me and see me now?
You look good.
Yeah, we can. So.
Okay. Sorry there, guys.
And if you want to take control of the PowerPoint, you can, Chris. You're welcome to take control of the screen anytime you want to.
I'm going to, if that's okay with you, Jake.
Please do.
I've got this, so I'm going to take control and I'm just going to run with it. Is that all right, guys?
Absolutely. If that was a test, I think I did pretty good, but you go ahead and take control there. So.
You did good. He did good.
I'm sure he did. He's better than me. We already hit the disclaimer, so we can skip that. But Jake, I'll let you just jump in because this is where you're at, talking about the right approach, and then we'll kind of get going.
Yeah, and it's the difference in tax planning and tax prep. I can't remember if it was Kendall or Chris in the beginning where, we're talking about it's halfway through the year, right? And we're past March when the business returns are due, or past April when your personal returns are due. Why would we be talking about taxes in June? And it's because it's important. It's what you do today and moving forward is the difference between tax planning and tax preparation. And so, if we were in a live room, I'd ask everyone to raise their hand if they're ever guilty of, being that person that brings the box of receipts into your accountant's office, 2 days before the deadline at 11 o'clock at night. It's, in reality, are there, deductions that we can find for people that they didn't take in previous years? Yes. Do we find things that were missed and do amendments? Yes. But true tax planning is where the real savings comes in. And so, we're halfway through the year. In this presentation, we like to go through several deductions. Chris loves to change the presentation on me too. So we'll see which ones he's got for us tonight. But the big thing is implementation. We tell our clients is we can give you all the information in the world. We can tell you all these great stories about how we've saved our clients, literally millions of dollars in taxes over the past several years. But it really, it falls on you as, you know, in this case, the student, or if you were to become our client, of you got to implement this stuff. And so we're going to go through some deductions here over the next few slides. And a lot of these can be really powerful. A lot of these are, or several of these are very simple though, too. So just think of the compounding effect that this stuff has year over year. You know, kind of, Kendall, I love that question of how do we get into this industry? Because, you know, when I look back to myself, about a decade now, I guess it has been, is I wasn't even a business owner. I was a W-2 employee. I knew nothing about this stuff. And just, you know, so if you think of whatever situation you're in, if you can just employ one of these strategies per year, it's going to have a compounding effect year over year that's going to make a massive difference, you know, in where you end up a decade, 2 decades from now. So,
yeah, I think if there's, you know, we're going to cover, like Jake said, some strategies, but I think if there's one takeaway from tonight, before we move off of this point, this is the point that I'd really like to just drive home for the group. And that is simply this, that you have control over your taxes. And in fact, we've surveyed thousands of clients. It's heartbreaking for us to see that on average, we see business owners having over $50,000 in missing or potential deductions that they're not taking. And these are small and medium-sized business owners. And what you're doing today is going to impact the tax bill at the end of the year. You know, I liken this often to a sporting event. We're in the middle of the NBA finals, right? And once the finals are over, it's over. The champ's crowned. There's nothing you can do. And it's right now, it's the in-game, it's the in-series adjustments that are going to dictate the winner. And for us as business owners and investors, it's right now, it's the impact, the things that we do right now that are going to impact our ability or your accountant's ability to really help you save money. And so if you take nothing else away, if none of these strategies that we talked about tonight resonate with you, if nothing else hits home, take home the idea that you've got to take control, you've got to put a plan in place, and what you do now is going to impact it so that hopefully if you come take one of our surveys in the future, we can't find missing deductions because you're already taking advantage of it and you're not part of the group who on average is missing $50,000 in potential deductions, exemptions, exclusions from their tax bill. So with that said, what we'd really like to do, we're going to kind of go through a few things here with you this evening. We want to walk through some ideology, which we've started to hit on, and we'll hit on that throughout the evening. We want to hit on some specific tax strategies, and this isn't every tax strategy. We focus heavily on tax planning, and we have real robust software that helps us do that. And we actually look at over 1,400 strategies and tools that are state and federal tools and strategies to help our clients save money. So we've pulled just some of the common areas and things to be aware of, but by no means is this a comprehensive list. Some of these may apply to you, some of them may not, but the idea is this: there are undoubtedly strategies out there for you to implement, and we're going to pull a few off the top and help you understand what they are, but also on some of these help you share the real impact that they have on the tax bill. So Jake, one of the first ones that I wanted to bring up tonight with the advent of COVID is this idea of how do I qualify for a home office deduction? You know, COVID and the home office has become such a big thing. So how do I qualify for a home office deduction, and what do I need to be aware of when it comes to a home office deduction?
Yeah, and so the biggest thing with a home office, it has to be a separate area exclusively used for business. And so, you know, that's the first thing we tell people. It can't be your dining room table where, you know, you bust out the laptop once the kids go to bed, or and that sort of thing. It can't be a guest bedroom, you know, that you've also got a desk in, but you have your relatives, you know, sleep there when they spend the night, and those sort of things. It has to be a separate area, has to be exclusively used for business. And if you do, then you can qualify. We're actually seeing, not to get too off topic, but seeing a lot of sprout up like separate buildings, people building, you know, sheds in their backyard, and these separate kind of, it's actual separate office that people are building in their backyards. But, you know, once you do have the separate area.
We had a new spin on that last week, she sheds, right?
That's what I was trying to think of the name. I couldn't think of it, but the company's called She Sheds. Yeah, that's great. And so if you do qualify, you have the separate area exclusively used, then we come up with your business use percentage. And the way we do that is we take the square footage of that area divided by the square footage of the entire home. And then we can take that percentage of a lot of things, actually. So if you own the home, we can take that percentage. And the percentage usually comes out between 8 and 12% is pretty common. Sometimes a little higher, sometimes a little lower. But, you can take that percentage of, if you own the home, your real estate taxes and mortgage interest. If you rent the home, you can take that percentage of your rent, your utilities. In certain situations, improvements to your overall home. So if you think about it, if you got to put a new roof on your house, you can't roof the rest of it except for the home office. You have to do the whole thing. But so we could take the percentage of that cost and depreciate it over time. And so, home office is one I tell people you're probably not going to save $1 million a year in taxes on this, but this is one of those ones that adds up. If you qualify for it, you should absolutely take it, in my opinion.
So Jake, you just described to us the actual methodology, right, of the home office. And one of the things that we hit up on all the time is, well, hey, there's this simplified method that sounds really easy to me. I can take $5 per square feet up to $1,500. Which one's better, Jake? And I know that's the loaded question that we get asked all the time, but which one's better?
It depends, Chris. That's my infamous answer there. It's not so much which one's better overall, it's which one's better for you. So the the actual method, there is some tracking necessary. There are qualifications, obviously. 9 times out of 10, that's going to give you a better deduction. But if you don't want to mess with that, you can take the simplified method. So that says it's the same qualification, has to be a separate area exclusively used for business, but the IRS will essentially give you $5 per square feet for up to 300 square feet, which equates to a $1,500 tax deduction per year that a lot of people just aren't aware of. So.
And I want to share just one example from an actual client that I wanted to look at with everybody. A client named Sarah. She has a real estate business. I wanted to show you the reason that it's worth a little bit of energy to track this. Again, we can take the simplified method and just get $1,500, but Jake, I don't want to put you into a corner, but I'm going to dare say the majority of the time, the clients that you see track the expenses, the actual side ends up working out better for them. Is that a fair statement?
Oh yeah, 8 to 9 times out of 10 for sure. So
when we look at that, this is the reason that it's worth it. So Sarah has a business with an income of about $92,000. She utilized the home office deduction. It came out right where Jake said, about a 9% business usage. So she's able to go in and able to take things, real estate taxes, mortgage interest, utilities, improvement, equipment, furniture. And here's the real number that equated to. That was a deduction, a tax deduction of $6,273 on her taxes. Now, again, you look at that, this is one strategy, and that's one strategy laid year over year over year over year. 10 years, that's 60.
Well, see, he's putting you on the spot again there. See that?
He's trying it again. We lost Chris again. So I'm where he was going. It had to be, over 10 years, it's $62,000 in deductions. And so, back to kind of what I was saying a minute ago is this stuff has a compound effect. If you are, even if you're just getting one strategy from, this session right here, employ one, do one at a time, do one every year. And over time, this stuff is going to compound and it's going to add up for you. So I'm almost positive that's where Chris was going with that. And I see him chiming back in here. So I'll let him bring it up and we'll let him take it back away there. So
yeah,
it wouldn't be fun. Yeah, it wouldn't be fun if everything just worked the right way,
No,
so
it's not supposed to.
I'm okay with that.
It's not supposed to.
The next one,
this next one here
is QRPs. I can see there. So if I could cheat a little bit before Chris actually comes back on. So the home office deduction, that's really it on that one. There you are, Chris.
Hey guys, I really apologize. I'm home with COVID instead of in the office. I've never had issues in my home office, but I am tonight, so I greatly apologize.
The kids are watching Netflix. It happens to me every time, I guarantee.
Something's going on.
It's okay. Go ahead and take it back if you want to.
So you guys have already jumped ahead of me and got to QRPs. But before we get to an example of a QRP, Jake, I want you to fill us in on why a QRP matters and what we should be looking at, and what are perhaps some of the additional areas that a lot of business owners aren't aware of when it comes to kind of non-traditional being able to sock more money away than people realize.
And make sure you explain what a QRP is. Or most of our people know, but you're pretty clear about that, Jake. But sometimes people don't know.
Yeah, absolutely. Thank you for pointing that out, Kendall. QRP stands for Qualified Retirement Plan. And so, kind of back to myself, when I was employee, I had a 401k, but I didn't really know much about how it worked or the fees or anything. I just put money in there. As a business owner, you're eligible to have a qualified retirement plan. And there's several different ones out there. Chris, I'll just kind of give a couple different examples of what's available. And I'm sure you're going to give us some actual examples there too. But, there's really, if you are a business owner, you definitely want to have some sort of qualified retirement plan. Probably the most common and just easiest to set up is just an individual IRA, which is an individual retirement account. With those, you can put up to $6,000 per year into the account, which is a tax deduction for you in the year, in that tax year. And then you have this money growing for you in a tax deferred vehicle that you can invest in all sorts of different avenues. And so, that's just one that comes to mind once, and that's usually for like when you first start your business, or if you are leaving an employer and you want to roll over your 401k. A lot of times people will roll those in IRAs. Those are very common. Another one's a SEP IRA, which SEP stands for Simplified Employee Pension. It's a little fancier. There's a little more requirements there, as far as the owner has to be on salary, and you've got some earning requirements for when those really make sense. But, plans like that, you could put over $50,000 a year in them. And this is money you get deductions on in the current year, and you're putting this money away from retirement that's going to be compounding over time. And so another one comes to mind is a solo 401k plan. And that's actually, Chris, I don't want to steal your thunder. I don't know if you're going to tell your story about your solo 401k, but on these, the interesting part there is if you and your spouse both work in your business, you can actually, I don't want to say double tip, that's a bad term, but you can both contribute to a solo 401k over $50,000 a piece. This is like 6 figures per year plus potentially that you can get deductions on and be storing away for retirement. So, this is where when we bring these things up to our clients, it's kind of that shock moment of like, why didn't somebody else ever tell me about this? But these things are out there, and just the more you learn about them and the more you work with somebody who's proactive in offering them to you, the better you're going to end up. So.
Well, that's the experience that I had, and Jake alluded to it. I mentioned at the beginning kind of that mind exploding experience I had. I was sitting around with some business partners in an office, and one of the guys was telling me that he was contributing over $50,000 a year to a retirement plan. And I said, that's impossible. You can't do that. And, I was saving some money in an IRA or something, but I was nowhere near.
Probably doing the 6,000, Chris, right? And
you're like,
that's way too much. You can't do that much. There's only
like, no, you can't do that. Somebody's lying to you. Right. And he said, no. And he explained it to me. And I remember that was when my mind exploded. And I realized when I understood the qualifications and the criteria that I could have been socking away $50,000 to $100,000 a year, tax deferred, and that my accountant had never even brought this idea up to me. My mind completely lost it, and I just went, "What in the world am I doing with this accountant?" And that was one of my first kind of experiences. Kendall, you mentioned earlier, sometimes if you don't have the right people, it costs you more than paying the right people. And that was my experience. And I just, again, wanted to make sure that we understand the power of what we're talking about here. So here's a client, Jaden S. He's in the medical field. Jake, I actually think you worked with him directly. You can correct me if I'm wrong there, but recommended putting $61,000 because of where you sat with him and his spouse into a solo K contribution. That $61,000 contribution equates to a real tax savings of $24,400. So what does that mean? That means that if Jaden goes and executes on this, Jaden doesn't make any more money, but he has an additional $24,000 working for him, compounding for him in his retirement plan. Now, some people will say, well, hey, I can't put that much money aside. I can't put that much money away this year. Well, you don't have to. You can kind of tier into this. Here's Stacy from Virginia. She's a mental health counselor, makes about 165 grand in net revenue. She was able to contribute 92, 93 into a SEP that saved her about $22,000. But this year, because of where she sits, she's going to be able to put $25,000 away for a tax savings of $5,500. And so again, year over year over year, we want to be looking and planning and making sure that we've balanced things correctly and we've put the money where we can get it. And again, this is one strategy. Whether you're saving $5,000 a year or $20,000 a year, that's a lot of money over 5-10 years that's moving into a retirement account that's compounding for you, that's putting you in a position where you really truly are able to grow that wealth differently than perhaps you have in the past. Anything, Jake, you'd add there about qualified retirement plans before I hit another one here?
Well, sorry, I was kind of chomping at the bit on this one because I do remember this client. I worked with this client actually. And so she's a mental health counselor who was working out of her house because of COVID. So seeing clients virtually all day long. And so with her, we were able to, I don't know if you're going to talk about it, but we were able to take an S election, which saved her, I don't have the exact numbers, but close to $10,000 right there. We took the home office deduction that she wasn't aware of that she qualified for, and this qualified retirement plan. This was absolutely a home run right here. So I get excited about this stuff. Sorry.
It's year over year.
Darn, we lost him again.
Look at that. So
Netflix.
Gotta be somebody's playing video games or something, right?
Yeah, no, this is cool strategy though. We find this all the time too. Seriously, a lot of our students on the call, they're pretty tax savvy, but it's a lot of times comes in layers. Now, you guys do a really good job at kind of sitting down. What I like about you guys at Tax Savvy is sometimes it's really hard on your own to take the overall picture of your plan and then break it down like you guys did. So you guys did an S election, right? And you did a QRP. And what else did you guys do? A few other things. Oh, home office that she wasn't doing. To me, that's just second nature now. I get it, but for most people, it's not. And that's huge. Like you said, year over year, Chris, that's huge savings.
It's a lot of money. I did see a question come through, so I'm going to actually skip to a slide and just share. We're going to share this at the end, but because I did see this question come through of how to get in touch with Tax Hive, I'm going to skip ahead to this. I know a lot of you are busy. If for some reason you do need to leave, but you feel like you're in a position where you aren't taking full advantage of the tax deductions, we have a special offer for all Protect Wealth clients. We have two things. Number one, we're so confident in what we do that we have a $10,000 guarantee that Kevin convinced us to put in place. And it's simply this: if you meet with us and we can't find at least $10,000 in missing or potential deductions, we'll actually pay you $100 for your time. Now, Kevin and Jake and I, we aren't interested in paying people $100, so we're really good at finding those missing deductions. But for anybody tonight who goes and schedules a time to talk to our team, we're also going to give away our ebook, The Top 7 Ways to Stop Leaking Money in Your Business. So what I might encourage all of us to do, it'll take 30 seconds right now, is actually just stop and go to protectwealth.com/tax hive. And what you'll be able to do there is just pick a time that works for you and schedule a time with one of our talented team members to be able to have a conversation about where you're at and what it is that you're doing. So perhaps before the night gets away from you, just pull out your phone or even jump onto your browser, go to protectwealth.com/tax hive. Perhaps make this your first step in actually taking control of your tax situation and doing something about it to make sure that you're not overpaying. And we'll put that $10,000 guarantee in place. And we'll also give you our ebook, The Top 7 Ways to Stop Making Money. So for whoever it was that had to jump off and was wondering how to get in touch, there's how you do it.
Yeah, so I did put that in the chat screen, by the way, guys. So everybody who's on, you can actually click on that link there in the chat screen. So you should be good to go there. Click on that. Really cool process, Chris and Jake. I've talked to a few people who have done this, and it goes through kind of a questionnaire process. And that's pretty cool. Just questions you guys have developed over time, almost like artificial intelligence that kind of goes through, and that's beautiful. It's kind of a neat process.
Yeah, thank you for that. There's a lot of time, a lot of energy has gone into that, and it is very thorough. So it'll take a few minutes just to answer all the questions, but that's how we're able to do, what we do is we find all the information, find as much information as possible, and the plans are designed specifically for each customer. And so, no, thank you for that. So,
yeah, it's kind of cool. Now, did we lose Chris again?
I think he might have popped out here. What if we do this though? While he's coming back, I see some questions popping in here. Yeah. I could answer those, kind of randomly as we're waiting for him there. So I feel bad. He's dealing with his tech issues.
It happens.
Yeah. So if you're okay with that, I'll answer this question from Sharon. Said, I sold a vacation home. I stayed in it 5 months every year and owned it for 6 years. Is there a way I wouldn't have to pay taxes on this for this year? The answer is yes. That's an amazing question, actually, Sharon. So the IRS says if you live in a home for 2 out of 5 years, doesn't need to be consecutive 2 years, just a total time period of 2 out of 5 years, then you can sell the home. You can actually exclude up to $250,000 in gain if you're filing single, to $500,000 in gain if you're married filing jointly. So that's a great question right there. Somebody asked, is having a W-2 job along with my LLC business from home qualify for the home office deduction? Yeah, the answer to that would be absolutely. So the expenses for your W-2 job would not qualify per se, but the expenses incurred in the pursuit of a profit under your LLC business would absolutely qualify you for the home office deduction. So great question right there.
And by the way, I think about that one, Jake. We get a lot of people that call us about that one, and they said their accountant said, don't do it. It's a red flag. Don't do the home office. It's so scary. So they don't do it. What?
Well, it's interesting you say that, because I hear that quite often. I mean, never from us, because we're big proponents of it. I mean, I'm in my home office right now. Chris is at his home office with terrible internet, obviously. And just kidding, Chris.
I actually just switched computers because I'm not convinced it's my internet. So
sounds good. You sound good.
So
it was just perfect timing when you chime back in. But no, and Chris, we, Kendall was mentioning people get told that the home office is a red flag of sorts, and I, is leading me to our, kind of explanation of we're never here to cross the line, but we're here to understand it and take advantage of every deduction that's legally and morally possible. So if you qualify for it, our stance is to take it. Now, are you going to have really good documentation and understanding and, things like that? Absolutely. But, Chris, I know you're a big proponent of that as well. So,
well, one of the things I always tell people is we want to look at, is it defensible? Meaning, I hate this idea of, well, it's a red flag, don't take it. Well, if it's legal, take the deduction. Just make sure you have the evidence so that if you get called on it, you're able to actually defend the position and you're in a spot where you can show what you did and everything's okay. And when you do that, it becomes a non-issue. So don't be afraid to take a deduction. Just make sure that you actually have the needed info so you don't find yourself in trouble if you do something that might be one of those things that raises your risk of an audit. Jake, one of the things that I wanted to have you hit on, we get asked a lot about writing off vehicles. And I wanted you to talk a little bit about Section 179 and being able to accelerate depreciation. And I'm going to make you tell a story here about a yacht that you wrote off. But I'd love you to help us just understand why 179 for us as business owners is one of our favorite sections and what we need to be aware of it. And maybe we can't write off a yacht, but how it applies to vehicles.
Yeah, absolutely. And so we'll start with the yacht story because that's an exciting one. So in a lot of entrepreneurs, a lot of business owners are familiar with the concept of Section 179. It's also known as bonus depreciation. With as it pertains to vehicles, if you purchase a vehicle over 6,000 pounds and use it for more than 50% business usage, you can actually deduct the entire price of that vehicle in the year you place it in service. So in 1 year, although you might be making payments on your $80,000 SUV, that'll cost you $100,000 these days. You might be able to write off the entire cost of that in the year you purchase it. And so what a lot of people aren't familiar with is Section 179 is a very, very extensive section in the Internal Revenue Code. And so when it was 2018, I think, 2018, when the Tax Cuts and Jobs Act came out, they made a lot of changes to Section 179, and it was specifically around the purchase of luxury yachts, specifically for chartering purposes. And so we had a client, this was back a few years ago, and this guy was from Texas. He was making crazy money. I think he made something like $8 million that year, something ridiculous. And so we're sitting around, we're strategizing. We started early, obviously, and we're just sort of having a conversation. We have our formal questionnaire that we go through and those sort of things. But the things that come up when you just really have a conversation with a client are, and we're sitting there and he's like, I'm gonna make a ton of money. What can we do? We want to save as much as possible. And so, we started asking questions, and somehow the idea of this boat came up. He said, man, I want to buy this boat, but my wife will kill me. He's like, and I know there's no tax deductions for that. And I was like, well, tell me about it. Like, what are we talking about here? He's like, man, this thing is beautiful. 60-foot Cantius. It's got like 3 stories on it, 2 bedrooms, all this. He's describing it to me, showing pictures, getting all excited. And so we went and did some research, and it turns out when they passed the Tax Cuts and Jobs Act in 2018, they raised the limits of Section 179 depreciation for luxury yachts that were specifically purchased for business chartering purposes. And so we went to work. And so we started a company for the client. We actually found a company called Anchor, which is an app on your phone that you can download, which is kind of like Airbnb for yachts, if you will, or Uber for yachts. If you want to rent a yacht for the day, you go on there, there's pictures of it, tells you when it's available, how many people you want to do, and the company puts together the crew and the whole thing. So it's actually a business. So we client ended up purchasing this yacht. So not for personal purposes, but for business use. We put it under the company's name. We enlisted it in this Anchor program. They came out, took pictures, listed it on the website, all that kind of stuff on the app. And it turned out the math on this thing was really crazy. It was a $2 million boat. It was $1.9 million. And so to purchase the yacht, you don't have to pay the whole $1.9 million. You needed a 20% down payment. So it's about $400,000 down payment. And then it was about $10,000 a month to maintenance it for the payments and all sorts of things too. And so what if we did that and we set it all up the right way? We could take a $1.9 million deduction. We could depreciate the full value of the yacht in 1 year. So this guy was in a 37% tax bracket. It turned out to a $700,000 tax savings. It's 37% of $1.9 million. So it turned into a situation of, do you want to write a check to the IRS or do you want to write a check to the yacht dealership? And so, the $700,000 that he didn't pay in taxes, $400,000 of that went to the purchase of the business vessel. And then it basically covered the maintenance on it for 2.5 years as well too. So that was a rather fun one right there. So
now I think a lot of people are going to sit here and shake their head and say, why in the world did Chris want Jake to share a story about writing off a $2 million yacht? And it's because inside of that, there's a lot of really important principles. Section 179 kicks in when you buy a vehicle over 6,000 pounds. That's why you've heard the 6,000 pound idea. Well, if I buy a vehicle under 6,000 pounds, normal depreciation is what happens. But if I buy a vehicle over 6,000 pounds, a truck, a large SUV, there's, I think,
trailers.
trailers. I think I saw the new Jeep Wrangler
that's the electric Wrangler, because the batteries weighs over 6,000 pounds now. That kicks into Section 179, and it allows you to write off potentially the entire amount of the vehicle year one. You don't have to depreciate it over time. Now, you may choose to take just a piece of it now, or a piece of it, some this year and some next year, depending on where your income sits. But this same section that benefits the guy making millions of dollars with the yacht actually benefits the small business owner that lives down the street when it comes to vehicles. So these strategies that have been written into the tax code aren't just for the uber wealthy. They're for the everyday entrepreneur. And Jake, maybe to ask you a question, why is that? Why is the tax code written to benefit the entrepreneur? I mean, you see this, the W-2 employee, there's only so many things they can do. There's maybe 10 tax deductions they can look at. And like I'd mentioned with our clients, we look at comparing over 1,400 different strategies or mix of strategies used in our software. Why does that tax code open up? Why has the government done that for the small business owner?
Yeah, and I mean, when you understand economics, and you really look at it, it's not a political issue, right? It's not like a Democrat or Republican thing. It's about driving the U.S. economy. And we know 2/3 of all jobs are created by small businesses, and over 40% of economic activity in the U.S. is driven by small businesses. So these are dollars you can save and invest back into your companies. We saw what happened, during COVID, when small businesses, not big ones necessarily, got closed down. And politicians know this. They've designed the tax code to incentivize people to invest and build in their communities. That's what it is. It's, at the end of the day, the tax code is written to help businesses keep more dollars to build and grow. But you have to the biggest thing is you have to understand the rules to be able to take advantage of them.
For sure. I think that's just such the critical piece that I always like our clients to understand is, again, this isn't just out of the goodness of the government's heart. They know that you as an entrepreneur, as a business owner, fuels the economy. They know that about you. So they want to incentivize you to invest. They want to incentivize business. Not the Microsofts, the Googles of the world. We get in arguments about that. Should they pay more or less in taxes? But Democrat, Republican, doesn't matter. They want small businesses in their communities to thrive because you drive the economy. I've got just a couple more strategies that we would be remiss if we didn't get on the table here, Jake. Yeah. So you already kind of started to let the cat out of the bag on this one. But we get asked this question. You're going to hate how I frame it, but I frame it this way on purpose because it's what we hear. What's the best entity type to be taxed as?
You love that one. It's funny because we get that question all the time, and it's not a best overall. It's a what's best for you. I think, I know, a lot of clients, and I think Kendall was saying it earlier, your Uncle Phil might not be the best person to give you advice on go set up a parent company, that's owned by 3 different LLCs, and you got to do it this way for all these different reasons. It's really what's best for your situation. The single member LLC. So if you set up an LLC with one owner, a lot of people don't realize this. It's taxed the exact same way as if you didn't have it. It's taxed on your individual tax return. The IRS doesn't necessarily even recognize an LLC. You have to tell them how you want it to be taxed. And so, we see clients do that, and they think they're getting this huge advantage when they're not. It's essentially you're becoming a business owner, but you're still getting taxed as an individual, which is the worst thing you could do. So if you set up an LLC and it has 2 owners, we see this all the time as well. It's say me and my spouse, but I want her to have 5% for whatever reason. A lot of people don't realize, well, when you set up an LLC with 2 members, as soon as you get an EIN number, the IRS is expecting a partnership tax return, a 1065, which is a completely different tax return from your personal 1040. And if you don't file those on time every year, the penalties can add up really quick. The one that, I don't want to say it's the most popular, but can be the most advantageous if it's the right situation, is the S corporation. And it's funny because people say all the time, like, I want to be an S corporation, and an S corporation isn't even an actual thing. Majority of times you are an LLC, but you're taxed as an S corporation. So, when you do that, The greatest benefit is you're going to save greatly on the self-employment taxes, but the requirements for that, there's several, but the two main ones are you're now going to file two tax returns. You're going to file a business return and a business tax return and a personal tax return. And as an owner, you need to put yourself on payroll. So there's a ton of them out there. It's just a couple to highlight. So
I thought it'd be really good, Jake, just to show them how this really impacts the tax situation, to show everybody here. And so again, here's an actual client, Austin from Texas, owns a marketing business, an internet marketing business, gross income of approximately $100,000 a year. So we're not talking about somebody making millions here, right? We're talking about $100,000 a year after deductions, a net income of just under $50,000. Well, if taxed on a Schedule C, which is kind of how he was set up, and self-employment tax, there'd be almost $7,500 in self-employment tax paid. I think it's 15.3%, Jake. Does that sound right? Self-employment tax. And,
yeah, absolutely.
Moving over to the S election, went down to $1,530 in self-employment tax. So an actual net savings. This isn't a tax deduction. This is an actual net savings in the tax bill of $5,885. And so when you look at it again, just this one little strategy at the right time of moving to an S election, which so often we see people not do, put an extra $5,800 in change in Austin's pocket. Now, think about this. If you're a business owner netting $50,000 a year, and one strategy helps increase your profits or your actual cash retained in your business by over 10%, that's massive. And again, it's these onesies and twosies stacked on top of each other that make a big difference. Now, Jake, you mentioned this already. There's this requirement to file two filings for the owner to go on payroll. One thing that it might be great for you just to share briefly is the payroll rule is vague, I think, on purpose from the IRS, right? You've got to pay yourself a reasonable salary. If I'm running a business, what do I have to pay myself if I'm going to take this S Corp election?
Yeah, and that's a question we get quite often too. And there's no actual number out there, but like you said, the IRS loves to be vague for whatever reason when it comes to these things. But they call it a reasonable salary, and so an easy number is a third of whatever the gross revenue is of the business. If we just kind of need to throw like a staple out there, that's usually what we'll use. But it really all depends on the owner's involvement of the business and just the overall nature of it too. So, the easiest way to explain is it's got to make sense. If you're netting $500,000 a year and we're reporting a $25,000 salary, that's probably not going to fly. Something like that is going to raise a red flag. But if you're making 150 and we're claiming 50,000 as a salary, that's more than enough to suffice, in my opinion, depending on the situation, obviously. And even in that situation, the savings, of the difference is close to $15,000. So hopefully that helps there.
Great. Now I want to hit one more strategy. I know we're coming up on an hour, but I want to hit one more strategy and then leave a little bit of time for Q&A, Jake.
Okay.
I saved this one for last because I think out of all the strategies, to me, this is just one of the funnest strategies, and it's one that boggles my mind that people haven't heard of. What is the Augusta rule?
Hey, there you go. One of my personal favorites too, near and dear to my heart, actually. So the Augusta rule is a nickname for Internal Revenue Code Section 280A, which states that as a homeowner, you can rent out your primary residence for up to 14 days per year, and the income derived from that activity is tax-free to you as a taxpayer. And so there's really two main ways we see this used. There could be all kinds of different ones, but if you live in a heavily populated area or somewhere where the Super Bowl is coming to town or something like that, you can literally rent your house out on an Airbnb or whatever website you want to list it on, and whatever income is derived from there up to 14 days would be tax-free to you. Where we see it used a lot is as business owners, we're constantly renting venues, right? We're renting hotels, we're renting meeting spaces or taking clients to events and those sort of things. So The Augusta rule says as a business owner, you can actually rent your home from you up to 14 days per year. And, you know, it has to be for a specific business purpose, has to be in line with fair market value. You know, you can't rent your house to yourself for $20,000 a night or anything like that. But if you do those things, if it's a specific business purpose and it's in line with fair market value, you can do it up to 14 times per year. And that money is then a deduction from your business, and it's tax-free to you as a taxpayer.
So let's just look at a real world example here, Jake, of another one of the clients that you've actually worked with. And then we'll get to some Q&A. But this is Scott from Florida. He owns a number of businesses, has a lot of stuff going on. And
that's it in a nutshell.
Yeah. He bought a beautiful home right on the Intercoastal Highway there, $2 million. Using 280A, he was able to see that this house would rent out for $1,500 a night. So what did he do? He rented it to himself, to his business, 12 times. You can actually do this a maximum of 14 times a year for board meetings, for networking meetings, for training events. He rented it out 12 times. He didn't max it out at 14, 12 times at $1,500 a day. That's an $18,000 deduction that he got. Again, the business took the $18,000 deduction. He paid himself, and he didn't have to pay taxes on that. Now, I'll give one caveat to this strategy in particular. Make sure that you use great documentation if you're going to use this. Don't just come to us or your accountant at the end of the year and say, oh, $10,000 in Augusta rule deductions. Don't do that. You've got to have a lease agreement between you and your business. You've got to have a record of payment, a receipt. And we want to make sure that, again, we do this right. We don't want to be afraid of writing things off. We want to make sure that we do it right so that in the event that we do have to produce things for it, we can. So do this. Feel free to do this. Implement. I love the Augusta rule. It's up to 14 nights a year, but actually hold the board meeting. Actually hold the network meeting. Actually have a lease agreement. Actually have minutes from your board meeting to back all of this up so that come tax time, you can get a deduction for something that you're already paying money for. These are things that we're already spending money on as business owners. So I love that one. I do want to get to Q&A. Again, though, before we get to Q&A, you're in control of your tax situation. And what you do now is going to impact what you pay at tax time. What you do today, we're already at halftime. If we're looking at this year, we're already halfway into the year. And so our invitation to each of you is right now, as a responsible business owner, take control of your situation. If there's anything at all that you feel you don't have completely dialed in, go to protectwealth.com/tax-hive, and right now schedule an appointment. So I want to give you just 30 seconds before we get to Q&A. Pull out your phone, pull up your browser. We don't have unlimited spots to do this, but we have opened up extra spots specifically because of our relationship with Protect Wealth to hold additional meetings over the next few days here for Protect Wealth clients specifically. And again, as you schedule that appointment, you're going to get the free ebook, and you're going to get our guarantee that we'll find $10,000 in missing or potential business tax deductions, or we'll actually pay you $100. I'm not interested in paying you $100. We'll send you a report showing you those missing deductions. I'm confident that we'll find them. So just take the last 10 seconds here, go to protectwealth.com/tax-hive, schedule that time to have a free consultation, a free strategy session to see what, if anything, we can do to help you and your business out. And while people are doing that, Jake, why don't we jump in and take a few questions if that's okay?
Absolutely. Yep.
First, I've got them up here, and Kendall, certainly if you see something that you think we need to make sure to hit, feel free. But coming back to section 179, does the vehicle have to be brand new or can it be used? What are the rules around the vehicle that I buy?
I love this term. It has to be new to you. Doesn't have to be new. It could be a used vehicle. If it's new purchase for you, then it can still qualify. Yes.
Great. Section 179, another 179. I'm an Uber driver. If the vehicle's over 6,000 pounds, does that apply to me as an Uber driver, or Are there certain rules about the kind of business I need to be in?
Absolutely. It could apply as long as you use it for as long as you use the vehicle for more than 50% business usage, then it could apply. Absolutely. So
one thing I'll just point out here, business usage matters with vehicles, regardless of whether it's 179 or not. But particularly with 179, if you're going to accelerate depreciation, something that we see people do at the end of the year is a tax saving strategy. If they know they're going to need a new vehicle in their business, they'll buy that vehicle at the end of the year, and they will use it strictly from November through January for 100% business purposes only. Keep great records, great notes on what they're using that vehicle for. Take that depreciation and retain all the evidence that it really is used for business purposes, and be really diligent in that first kind of segment of owning the vehicle. Jake, you'd mentioned this rule of kind of 1/3 of wages of your net income or of your income for the S Corp. The question was, is that of my gross or is that of my net for your rule? And I know that's a loose rule of thumb.
Yeah, loosely it's on gross, depending on the situation. So kind of my example is, if your gross revenue is 150,000, say you got about 50,000 in expenses, a $50,000 salary would be good. So it's all based on the situation.
Here's a great question. In what time frame do I need to show a profit if I'm a small business owner and I'm taking deductions?
So the IRS says you to not be considered a hobby, you have to show a profit 2 out of 5 years. 2 out of 5 years or 3 out of 5 years. I always get confused on that one. But in the beginning, you can definitely show losses and not have to worry about that as long as you have good documentation. So
the one thing that I'll point out is startup businesses certainly are great. We think everybody should own a business. Startup business is great. You can take losses. Some strategies, though, you can't implement unless you're showing profits. So for example, a qualified retirement plan, if you're not making money, that doesn't really work. So there's certain strategies that you do have to show money. There's other strategies, though, if you're in startup mode, potentially even grants or tax credits, different things along those lines. Give us some ideas on setting up a QRP. What are some of the things? I know we talked about this a little bit, Jake, but some of the things I need to be aware of. Where do I go to set one up? Things along those lines.
Yeah, I mean, the simple ones, the individual IRA, a lot of those you can set up online at your bank, whoever your business bank is or financial institution. You can set those up. If you're going to do like a SEP IRA or a solo 401k, I mean, I'd advise going through a financial planner or somebody who specifically works with those. If you need somebody, we can refer you. I'm sure Kendall's got a handful of people who could refer you guys to. But yeah, general rule of thumb, an individual IRA is a pretty straightforward thing. I think you could do that on your own. If you're going to do anything in excess of that, I would work with a professional for sure. So.
And that's, you're going to want to, when you're making good money, that's when the SEPs, the solo Ks, the things of that nature start to play in. And you're going to need a good accountant to help you understand the tax side of it, and a good financial planner to help you execute the actual logistics side of it there too. Go ahead.
You want them to work. You want them to work together too. That's the big thing on that one. So just to throw that out there.
Can I deduct the cost of a new computer all up front for my computer consulting company, or is that something I need to amortize?
More than likely, you could depreciate it all in the first year, depending on the cost. I say if it's within normal $1,000, $1,500 range, you should be able to depreciate that all in the first year.
That's great. Well, we're right here out of time. I don't want to take more time than Kendall and Don have been so nice to give us. But again, our invitation is this: your business owners, your investors, what you do matters, and you deserve to keep every dollar in your pocket that you can. We would love the opportunity to have just a free strategy session with you and look for those potential deductions, exemptions, and exclusions. Take control over your situation. Take an action. If you haven't, again, we've opened up a few extra spots specifically for Protect Wealth clients for the training here this evening. So go to protectwealth.com/tax-hive to access those spots that we've opened up. Schedule an appointment. You'll get our free book. You'll get our $10,000 guarantee, And we'd love to see what our team can do to help you out. Kendall, thanks so much for having us. Anything you'd throw in there at the end?
Well, one person did ask, are you actually able to complete the taxes, or are you just giving advice? Yeah, you guys actually do the taxes.
Yeah, so the short answer is absolutely we execute on taxes. And although we don't maybe drive that home as our core competency, it's what we do. It's what accountants do. What differentiates us, though, is this idea of planning and actually putting a plan together, because the plan's going to impact how well we're able to serve you at tax time. But absolutely, Jake manages and runs our entire team of accountants that manages the workflow for taxes.
Yeah, and so that's one of the biggest things for us at Protect Wealth. What we love about TaxHive is that you guys not only do the planning, you know, planning's so important. It's probably where the rubber hits the road, but also, gosh, doing your taxes is just a pain. It just is. It's painful. And so to have someone who can plan, like you said, most CPAs and accountants don't plan. First off, you hand them a box of receipts, whatever, right? And that happens. But for TaxHive, you guys actually do the planning and the prep. And then you guys even do bookkeeping for small businesses. I mean, you guys have a whole suite of services that way.
Yeah, for sure. We offer all that to our clients. We offer relationship pricing too. So people that work with us, it gets cheaper and cheaper to work with us the more services you use. But at the end of the day, we feel like what you save in taxes and by planning is got to justify the expenses of business owner. And that's really where we see our clients justifying being able to involve us as a professional partner, is they know that if they can go find and execute tax savings, it's well worth the investment. So go schedule that free appointment. And I think you've got it there in the chat, right, Kendall?
Yes.
People just click on it and schedule. And go schedule that appointment. We'd love to see what we can do to help you out.
Yeah, guys, we at Protect Wealth, we highly recommend it. We really do, just because tax planning, you know, at our summit next week, we'll have a lot of tax professionals on, things like that. But hitting the rubber hitting the road again is where we want you to reach out to TaxHive and actually get stuff done, you know? So sometimes it's hard to figure it yourself and want to do it yourself and plan. That's why you need some pros behind you doing it. So TaxHive, gosh, Chris and Jake, seriously, so much fun tonight. I really enjoy this topic. Again, it's going to make long-term, consistent results for all of you. If you do this stuff, gosh, you'll be so much better off. You'll be living the retirement of your dreams. And that is true. And I've heard that at real estate and stock investing workshops over and over. And that's like, okay, yeah, you can. But I mean, that money's going to come from somewhere sometimes. And here's where it comes from. More often than not, it comes from tax savings, I see, from all of our investors. So love it, guys. Thank you so much. That is in the chat screen. Click on that, fill it out. Is there anything else? I mean, a few people are asking about the books. Do they get the free books and things like that just automatically, or how does that work?
Yeah, so they'll get an email. You schedule that appointment, you'll get an email with the free download for the book.
Okay, so watch your email, and then you guys contact them within the next couple of days.
Yeah, so what will happen when you go to protectwealth.com/TaxHive, you'll actually select the appointment day and time. So you'll be able to schedule it right there. We're not going to play phone tag. You'll actually schedule it, put it on your calendar, and when you schedule that appointment, we'll get you that free ebook. Beautiful. Schedule it. Make sure and take their call, guys. It's a fun thing to see how much money you can save. You'd be surprised. Even if you guys you're so amazing at taxes, a lot of you really are. Watch out. I'm telling you guys, these guys have some, like I said, artificial intelligence. They came up with some things that you probably aren't thinking, but it's all there in the tax code. So make sure and go do it. So we highly recommend it. Guys, thanks for your time tonight. Jake, you gonna take us away and finish this with a rendition there on your guitar, or how's this gonna work?
I would, but we're almost out of time, you know, so
next time.
I don't want to steal the show. You know, we had such a great time. We talked about taxes for over an hour. You know, I don't want to mess it up with that.
We'll bring it up next time.
There we go. I'll do the
Thanks
intro
so much,
next
guys,
time.
for your time. We appreciate it very much.
Thanks. Have a great night.
Discussion tonight, guys.
See ya.
Thanks, guys. Have a good night.